Studies have shown that seasoned investors do research before they invest. These investors do not invest blindly. They conduct thorough research for several stocks. This helps them to reduce the risks of losing their money. One of the greatest investors of all time is Warren Buffett. So I did a lot of research of what he evaluates before investing in any stock and compiled it for you. Otherwise, kindly subscribe for more content. 1. Stock price and intrinsic value. Famous investor Warren Buffett made his billions by comparing the current market price of stocks to their fair market value. When he finds a company that's trading lower than the company's stock price should be, he pounces, taking advantage of the discount. Buffett knows that in the majority of cases, an undervalued stock will eventually climb to reach its fair or intrinsic value. This is a process known as value investing, a type of investing that puts the utmost importance on the valuation of a company and uses various metrics to determine whether the valuation is low, high, or where it should be. Some of the most important metrics include A. Price-to-earnings ratio, PE ratio. To understand what this is, I'm going to give a quick example. Imagine you had a choice to pick between two hedge funds. One has a long history of making people a lot of money. They tell you that for every dollar of profit they make for you, they are going to keep 40 cents, leaving you with 60 cents. The other hedge fund is just getting started in the business. They have very little experience and, although they seem promising, they don't have much of a track record of success. The advantage of investing your money with this financial advisor is that they are cheaper. They only want to keep 20 cents for every dollar they make you. But what if they don't make you as many dollars as the first financial advisor? That comparison is a form of a simple PE ratio. The PE ratio compares the price of a stock to the company's earnings per share, essentially putting a price on profitability. For example, if a company trading at $100 per share produces an earnings per share of $1 annually, its PE ratio is 10, suggesting that the share price is 10 times the company's earnings on an annual basis. B. Price-to-sales ratio, PS ratio. The price-to-sales ratio compares the price of the stock to the annual sales or revenue generated by the company. For example, if a stock trades at $10 per share and generates $5 per share in annual revenue, its price-to-sales ratio is 2. C. Price-to-book value ratio, PB ratio. Finally, the PB ratio compares the price of the stock to the net value of assets owned by the company, divided by the number of outstanding shares. For example, if a stock trades at $10, has a net asset value, book value, of $1 billion, and has 100 million outstanding shares, it has a PB ratio of 1. D. Debt-to-equity ratio. It is common to all companies because, at their balance sheet, they carry debts. It does not matter the wealth of the company, because even the richest also carry liabilities. Therefore, be wary of those companies having a higher amount of debt. When you check their balance sheet, compare their debt-to-equity ratio. You should look for a company having more assets but fewer liabilities. If you need a company to invest in and can provide you with a lower risk, choose one with a debt-to-equity ratio below 0.30. E. Dividends. A company will be able to pay dividends when it is stable. So try to avoid those companies having high yields because it's an early sign of instability. A company you will find paying investors a lot of dividends might not be the best because it means it is no longer reinvesting. So the best company is one that pays modest but regular and timely dividends. Therefore, avoid choosing the company blindly. Before buying a stock, look into various valuation metrics and how they compare to other stocks within the company's industry. If you're following the value investing strategy, you'll want to make sure the stocks you buy are undervalued compared to their peers. Even when following any other investing strategy, it's important to avoid overvalued stocks because the market has a history of correcting overvaluations with big dips. 2. What does the company do? Warren Buffett has invested little to no money in tech stock. While over the past 2 decades tech stocks, such as Amazon, have had a 200,000% return, Warren Buffett avoids them like plague, with him only having 6% of his investments in tech stock. According to him, he never invests in something he does not understand. This is not to say tech stocks are bad, he just simply does not understand them. Investors should avoid purchasing a stock unless they have an exhaustive knowledge of how the companies make money. What do they manufacture? What kind of service do they offer? In what countries do they operate? What is their flagship product, and how is it selling? Are they known as the leader in their field? It is essential to know how the company you want to choose is managed. Ask yourself, are those leading the company competent? What is the culture of the company? Do you find it innovative? As you ask yourself these questions, consider whether the company has a scandal that can harm its reputation. However, also remember some scandals are not permanent and only affect the company for a short period. If you get such a company that will likely recover, it can be a good deal. This information is very easy to find. Using the search engine of your choice, go to the company website and read about them. In regards to this, before you choose a company to buy stocks, check its stability. All companies usually have that period that their stock will lose value. It is something common, especially during economic difficulty and even market upheaval. Don't focus on the company's difficult period, but look at the overall stability relating to its economic conditions. If you find a high fluctuation, it might be a red flag. But if you find the company having trouble together with the others the moment the market is struggling, it might be an excellent option to consider to invest in its stocks. 3. Your time horizon. For Warren Buffett, if he cannot hold a stock for over 5 years, he won't buy it. Take, for example, the case of Coca-Cola, a stock which he has held for over 4 decades. According to the billionaire, the time horizon associated with an investment will play a crucial role in whether it makes sense for your situation. Time horizons are categorized into 3: long-term, short-term, and medium-term. Here's how time horizons break down. A short-term time horizon is any investment that you plan on owning for under 1 year. Investments with a short time horizon have little time for recovery if things go wrong. If you're planning on holding an investment for under a year, it's best to invest in stable blue-chip stocks that pay dividends. The companies represented by these stocks are large corporations with rock-solid balance sheets, making the risk of loss minimal. On the other hand, gains through these investments tend to happen at a slow, steady pace. A downside to this is taxes. In the US, any profit you gain from assets that you held for less than 12 months is taxes at double the tax rate, compared to if you held it longer than a year. A medium-term investment is an investment you intend to hold anywhere from 1 year and a day to 10 years. Due to the longer time horizon, you have more time to recover should something go wrong. Although you shouldn't dabble in penny stocks, even with a medium-term investment, the longer term opens the door to investing in quality emerging market stocks and other stocks with a moderate level of risk. Finally, long-term investments are any investment you plan on holding onto for more than 10 years. These investments have the most time to recover if something were to go wrong, giving you the ability to take the most risk in an attempt to generate a significant return. 4. Diversification. Diversification is an important part of building and maintaining a quality investment portfolio. This is the process of spreading your investments across various stocks and other securities across various industries and markets. Before buying a stock, it's important to consider the level of diversification that already exists within your portfolio. For example, you may be thinking about buying shares of Apple or Amazon.com, but when reviewing your current investments, you might realize all you have in your portfolio are tech stocks. What happens if the tech sector crashes? Well, your portfolio focused solely on tech stocks would tank along with the sector. However, if you consider buying stocks in another category, such as utilities or consumer staples instead of adding more tech stocks, should the bottom fall out of the tech sector, the other holdings in your portfolio will provide stability. According to Warren Buffett, the best diversification you can ever make in investing in an index fund. So, check out our video on the best index funds you can buy from anywhere in the world. 5. The company's capitalization. The size of the company you're considering investing in plays a major role in the amount of risk you take when you buy it. As a result, it's important to consider the size of the company in relation to your risk tolerance and time horizon before buying a stock. The size of publicly traded companies is determined by looking at the company's market capitalization, or the total market value of the company's outstanding shares of stock. For example, any stock with a total market cap of under $2 billion will fall into the penny stock category. These companies are relatively young with minimal, if any, profitability. As a result, they represent some of the highest risk investments. Mid-cap stocks have a market cap between $2 billion and $10 billion. These companies generally have something going for them. They've created a new product and started generating profits, and in most cases have a promising future ahead. However, they haven't quite made it big yet. Mid-cap stocks come with lower risk than penny stocks and small-cap stocks, but there's still a moderate level of risk, as these companies haven't attracted the masses quite yet. Finally, large-cap stocks are stocks representing companies with an overall value of more than $10 billion. In the vast majority of cases, these companies sell popular products and consistently produce significant profits, which are often returned to investors by way of dividends or share buybacks.